Hello everyone, welcome to Mark's Finance and Fitness. Today I'm excited to cover with you my top 10 ETFs that I recommend you consider for your portfolio. Now ETFs are a great way to diversify your portfolio and create some safety because you're not putting all your money into one company or a few companies. These ETFs allow you to spread that out over hundreds of companies. I think it's always good to hold a few, maybe like 4 to 6 companies in your portfolio. But outside of that, I think it's very healthy and appropriate to add some ETFs to reduce that risk. There is an ETF for everything these days. I'm talking you can get, an ETF for a specific sector of the market, like real estate, to mimic a certain index like the Nasdaq or the S&P 500. Or it can be as specific as you want an ETF that follows electric vehicle companies. So there's an ETF for everything, I'm telling you. Just search it and you'll be surprised what you'll find. But today I want to go over the ones that I feel are the best of the best. And so that's what we're going to do, and we're going to get started right now. So number 1 on the list is called Block, B-L-O-K. Now this one is going to deal with the development and utilization of transformational data sharing technologies. This one is very important if you want exposure to Bitcoin without owning Bitcoin, because this can be part of that transformational data. A lot of companies are starting to accept Bitcoin, and some of those companies you'll see on here, PayPal, Square, and if you want to be a part of that ride, if Bitcoin continues to go up or more companies start to accept it, this is an ETF you want to be in. Look at its performance. It's massive, 100% over the last year it's gone up. It does charge an expense ratio of 0.7, which is a little high to my liking, but I think it's appropriate for being actively managed. As you can see at the top there, most ETFs will be passively managed, but this one is actively managed, which means there's somebody there actively looking at this every day and choosing what they should do and what they think is the best. It pays a decent dividend at 1.88%, and you'll notice that it's mainly its exposure is mainly in North America and Asia, but it also has some in Europe and the Middle East. So again, if you're one that is on that whole Bitcoin craze, but you're a little too nervous to buy Bitcoin directly yourself because it has some barriers to it on owning it and storing it, then Block is a great ETF for you to get into to get some of that exposure. The next one I want to talk about is FREL. Now, FREL gets you exposure to the real estate market, and I think everyone needs to have some type of REIT or real estate related stock in their portfolio. Where FREL is the ETF that's going to diversify that for you. And if you look at FREL, its top holdings, there's some great companies in here. American Tower, Crown Castle, Digital Realty is a great one, and you're going to see it pays a good dividend, a healthy dividend of 3.77%. Its business is all in North America, which I like. It has a little bit in Canada, but most of it's in the United States. It has a low expense ratio of 0.084%, and the real estate market has been hit, so you'll see that its year performance is down by 10.95%. But that's towards the bottom of the rest of those similar ETFs you'll see there. So I think this does a great job. The other thing I want to share with you is I own this one. And the reason why I own this is because I have 2 other REIT direct companies that I own that are REITs. That's Realty Income, ticker symbol O, and also I own STWD. Those are not in the top 10 holdings here, so I'm really having a good mix of companies. I think it's important to research the top 10 holdings. You don't want to own American Tower Corporation individually, as well as this, REIT ETF, because then you're just going to be overexposing yourself to that one company when it's already in here and it's already the top holding. So I like to find ETFs that, either, let's say, unless if you are really, really believing in American Tower and you don't mind the crossover, but I think it's healthy to not have that crossover. So finding ETFs where the top 10 holdings might not be the side companies that you invest in is a good thing to keep in mind. The next one that I am excited to introduce is GLD. Now this one's a little different. It's like an ETF, but it's not investing in companies. It's investing in gold, literally gold itself. You're getting access to the gold market, and it is, removing those barriers, because if you want, to invest in gold, you're gonna have to buy gold, you're gonna have to store it, you're gonna have to insure it. But this allows you to skip all that and get directly involved with the access to the gold market. Now, GLD is backed by physical gold, and this gold is held in a trust. As you can see, this GLD has done very well this last year. It's up almost 17%. It charges an expense ratio of 0.4%, which isn't too bad. You'll notice there's no dividend here. Why is that? Because it's not investing in physical companies that are paying back its profits to shareholders. This isn't companies, this is physical gold. So if you want to get into this commodity, this is an excellent one to get into that I highly recommend. The next one I'm going to go over is QQQ. Now this one is very popular, and it's a great one to get into if you want to invest in the Nasdaq 100. So the top 100 companies of this index. Now these companies you'll be very familiar with. You'll see Apple, Microsoft, Amazon, Tesla, Facebook, Google, Nvidia, PayPal, and Adobe. As the information technology sector has done extremely well, you'll notice most of these are information technology companies. And so this has gone up 40% over the last year. It has a relatively low 0.2% expense ratio. It does pay a lower dividend at 0.55%, but you'll notice that a lot of the big tech companies are more growth companies, so they reward you in the growth rather than the dividend. But this is one that if you want to get in that Nasdaq 100, top 100 companies, I highly recommend this one. The next one we're going to go over is SCHA. Now this one I like. It's different because a lot of people think of those big companies that they hear in the news all the time, but what about the small guys? What about the small cap companies that nobody really talks about, or maybe it's too hard to research them because you don't hear a lot about them in the news? Well, SCHA is to the rescue. So this one will get you exposure to those small cap companies. As we can see, you probably haven't even heard of some of these in their top 10 holdings. I think Plug and Floor & Decor I've heard of. As you can see, the top 10 holdings are only 3.51% of all the companies that are in this ETF. So let's say one does horribly, it's barely gonna, hurt this ETF because it's very well weighted between all companies, I feel. So I think it's definitely low risk, and it pays an okay dividend at 1.05%. It's got a very low expense ratio, which I like, at 0.04%, and it's done well over the last year. It's up 23.41%. So if you want a way to invest in the smaller companies without having to do all that research trying to find out which ones may come out and do really well, I think this is a very good one to get into, and I might add this to my portfolio myself. The next one I'm going to share is one of my favorites. It might be the favorite of mine, and that's SCHD. This one invests in those top 100 US dividend companies, and this ETF makes sure that these companies have consistently been paying dividends and that they have the strength to keep paying those dividends. And as you can see, a lot of these companies are dividend aristocrats or dividend kings, which means they've been paying dividends for a long time and have been increasing those dividends. Coca-Cola, Pepsi, Texas Instruments, 3M. I mean, these are great companies that have been that pay great dividends. And you can see that this ETF pays a healthy dividend of 3.56%, has a very low expense ratio at 0.06%, and it's gone up almost 12% over the last year, which is great. Like I said, those growth companies that pay the lower dividends, usually they go up higher in appreciation of their stock price, where the companies that pay higher dividends might not go up as high, but that's why they reward you with a dividend. And so I think this one, if you want that income, that dividend income, it's probably the best one to get into, in my opinion. The next one I want to talk about is SPY. Now, I spy with my little eye a ETF here that's going to be great if you want to get into the S&P 500, so those top 500 companies in the S&P. And this one you're going to see that there's some similar companies from others, so Apple, Microsoft, Amazon, Facebook, very low expense ratio of 0.0945%. It's gone up 14% in the last year, and it pays an okay dividend of 1.78%. Now, I want to stress here that look at the top 10 holdings before you choose, ETFs, because you don't want to pick 3 ETFs that all invest in the similar companies, because then what's the point? You want to make sure that you have diversity. So you don't want to be in QQQ and this one and the others that have the majority of these in their top 10. You want to pick the one that you think is the best. And so with this one, I think SPY is a great one to follow the S&P 500. And there's some others as well, but this is the one that came out on top for me. The next one I'm going to talk about is VGT. Now this one is specific to an industry, so the information technology industry, and it's going to deal with both large, mid-size, and small US companies. So if you want this specific sector, this is a great one. Now you'll notice at the top I circled FTech, FTEC. I think that is a great runner-up, and I think you cannot go wrong with either of these. They both have gone up a healthy 35+%. This one pays a smaller dividend of 0.82, but again, information technologies is comprised of a lot of those growth companies. And as you can see here, this one has everything from Apple to Cisco, and it's going to get you great exposure to that information technologies sector. Next, I'm going to talk about VUG, B-U-G. So VUG is going to be the one for the growth stocks. Now, this is the one that I told you that they may not pay that high of dividend, but they're really focusing on growing that company. So if you want an ETF that is focusing on those growth stocks, this is the one to be in. And it's gone up 31%. So as you can see, it's following its motto of growth. It pays a smaller dividend, like I've said, 0.66%, but these companies are very solid. They have great futures. Apple, Microsoft, Amazon, Facebook, Tesla, Google, Visa, MasterCard, Nvidia. This one is a great one to get into, and it has a very low expense ratio of 0.04%. So if you want to focus on that growth, this is the one to get into. Now, the last one I'm going to talk about is one that I hold, and I think it's one that everyone should hold, or something similar, to get you into the international market. So that's non-US companies. VIXIS is going to do that for you. It's going to target the companies outside of the US that it feels will do the best. Now, I like VIXIS because it's going to expose you to those international companies without putting too much risk into one company. So what I'm saying is I prefer to get exposed to the international market through an ETF instead of buying individual companies, because it's important to know that if you own Chinese stock or something and something goes wrong with that company where it loses you a lot of money, you're not as protected as if you owned a US company. There's not really much protection for people that own foreign stocks, especially Chinese stocks. So if there's some big fraud or something, good luck trying to get your money back. Where in the US, there's a lot more rules and regulations that protect the owners and the consumers of those shares. And so VIXIS is a great way to get exposure and reducing that risk. Because if you look at its top 10 holdings, they're only 10% of this ETF, but they all have a very low exposure, with Alibaba at the top at 1.69%. Now, Alibaba has been in the news lately. Its owner, Jack Ma, has essentially disappeared. He came out and spoke against the Chinese government, and now no one has seen him. And it's very peculiar. You guys have to look up this case, but that's what I'm talking about. If you owned Alibaba, that's going to be stressing you the hell out, where now you own an ETF where it's only 1.69% of the total holdings. And so this one has a very low expense ratio of 0.08%. It's grown about 10% over the year, and it pays out a very good dividend of 2.19%. I think this is a great way to get exposure to that international, the international stocks without putting too much risk by getting individual stocks. That's just my opinion. So I hope this video was very helpful. I hope I provided you with 10 of the best ETFs, and I suggest that you Research these on your own and determine which ones you may want to add to your portfolio. I think ETFs are a great way. There's nothing wrong with ETFs. You know, some people will say that ETFs are for those that, you know, are lazy or don't really want to make profit. I don't buy that. ETFs have been proven to, you know, beat the market and those people that individually choose their companies many times. I think it's a very smart way to go about things. And like I said, I think a mix of ETFs and individual companies is probably the best way to go. So if you have 5 individual companies, see where maybe you don't have a sector that you're in and get into that with an ETF. And especially if there's an area where you're not very educated on, get an ETF in that area. That's the best solution to that. So with that said, I hope you guys enjoyed this video. I look forward to the next one. I appreciate all your support. I'd like to know if you guys hold any ETFs that you really love that aren't on this list. I'd really like to know because I like researching these. And again, research those top 10 companies and make sure you're not overlapping, getting 2 similar ETFs that are basically investing in the same companies. Then you can put your money to work diversifying elsewhere better. So have a great day, everyone. We'll talk to you soon on Mark's Finance and Fitness.